Today, we are delighted to have a seminar that addresses one of the key problems that has been with us since actually about, say, 1988, then the introduction of Basel I around that area, and the issues of bank regulation. The issues of bank regulation from the time of Basel I issued, and then a financial crisis breaks out, and then we transition to Basel II, and then another financial crisis breaks out. Then we see the inadequacy of Basel II, and then we transition to Basel III. And now that's after the global financial crisis. Now, a new type of crisis with the COVID-19 and problems of liquidity and causing problems in the functionality of banks and indeed on the stability of the banking systems, across the world. And therefore, it seems very, very appropriate at this time to go back into looking into how these bank regulatory frameworks are working, and is it that a time to move the the crossroads? Where we going to be transitioning to Basel IV, or we're going to have some of the elements from what works best in Basel III, but in particular about this issue, which actually came way back before the COVID-19, the issue of a bank capital and the related issue on whether this is addressing be able to reduce bank risk-taking behavior. I see in the audience many good colleagues and friends who have researched on this area. I see also colleagues from a number of central banks who are here. So this is going to be a brilliant conversation this afternoon to look at the work that Raphael Kasonde has put together. So as we start, let me, it's appropriate now to introduce Raphael Kasonde, who indeed has been working on this paper and will be sharing with us his research, design and findings, and to help us brainstorm on these issues. Raphael Kasonde is a solid member of the Center for Global Finance Network, and indeed is always present at the forums, the activities of the CGF network, especially on Wednesday morning in the CGF reading group, but also on the CGF research seminar. He's working now as Assistant Director, Examination and Surveillance in the Bank Supervision Department of the Bank of Zambia, the Central Bank of Zambia. Indeed, he has already established himself as a senior financial expert with 20 years across the main banking and finance areas, including bank supervision and regulation, financial analysis, risk management, accounting and auditing, and other applications of the financial economics terrain. In his day-to-day work, he's responsible for planning and directing the execution of examinations and surveillance programs of commercial banks in Zambia in order to assess the risk profile, financial soundness, and indeed compliance with the Banking and Financial Services Act in Zambia and any other applicable legislation. He's also charged with enforcing the financial supervision laws, internal controls, and other functions. Raphael is highly qualified. He holds a Bachelor of Accountancy from the School of Business at the Capability University in Zambia, an MBA from the Edinburgh Business School in Heriot-Watt University, UK, and an MSc in financial management from the same institution. He's also a professional accountant, as a fellow of the Association of Chartered Certified Accountant, ACCA, in the UK, and a fellow of the Zambia Institute of Chartered Accountants, ZICA. He also serves as a member of a board in the corporate governance of institutions, as a board member of the Lusaka Securities Exchange, and also he chairs the Finance and Audit Committee and the Listings Committee, and works also as an academic part-time at the University of Lusaka, especially in the areas of risk management, audit process, bank financial management, asset liability management, related issues. And he's passionate about his current work, and especially in looking at financial sector issues and using his research to influence policy. But most importantly, the work that he shares with us is part of his ongoing doctoral thesis at the University of Lincoln in the UK. And it is in that regard that we should look at this work as work in progress, and be generous with contributions, comments, questioning the key aspects of the research, the tentative research findings, and also question the potential application of this work to policy frameworks at the Bank of Zambia. So we are delighted today. So please join me in welcoming Raphael to share with us his exciting work that is questioning the continuity of key aspects of Basel III, especially on the leverage ratio in Basel III. You are welcome, Raphael. So let me give you a hand of applause to say welcome, and please go ahead and start your presentation. Thank you.
Yeah, thank you so much, Professor. I'm very grateful for this opportunity. Let me just pitch my presentation. I hope
yes,
you can
I
all
can see the
presentation. Okay.
Yeah.
Yeah. So thank you so much once more, Professor, for giving me this opportunity to share some of the views relating to this subject matter on capital. It's work that I've been involved in at the Bank of Zambia for quite some time. But of course, it's a different, aspect when you get into academia. There are a lot of, other perspectives that you have to look at, things rather than just from a policy making perspective. And thank you so much for that generous introduction. And I always, like starting with a disclaimer that, look, I'm a chartered accountant, and I'm trying to, sort of play in the field of, dominated by economists. And economists have realized they've got a way of, thinking through things. They are always, thinking through models, a lot of assumptions. And sometimes as an accountant, you find, you get, challenged and get confused. In fact, to prove that, I'm an accountant, I struggle actually to spell, there are two terms, one is homodastus. I won't even attempt that one. The cousin hetero, it's even more difficult for me. So that's, my background as an accountant. And I'm hoping that I'll have an opportunity to receive as many comments as possible from the distinguished economists in the CGF, network. And I would really be, grateful, as this is my first empirical, work transitioning from my background as a chartered accountant. Having said that, the roadmap in terms of the presentation, it follows a standard, roadmap with an introduction and a conclusion, and a number of activities, in between. So perhaps just to pick up where Professor Murinde, left in terms of the Basel, regulations, the history of the Basel regulations, so that I just give a bit of some background before I delve into my subject matter for this for today. As you are aware, Basel normally is, reactive. So whenever there's a crisis, they come up with somehow a set of, rules to try and fix what went wrong. In the 70s, we saw with, government's deregulation of the financial markets and a new phase in lending in the 70s, in the 80s. Basel I, was born specifically to deal with the issue of strengthening the global financial system, because at that time, whilst the financial system was becoming internationalized in terms of banks from Japan, from Europe, from the US, going around the world, the regulatory environments were sort of regional. So each country had its own set of rules. So to ensure that there is the international financial system is strengthened, the Basel I Capital Accord was agreed. Fast forward in the late 90s, again, we saw a crisis in Asia, the so-called Asian crisis, crisis in the South Americas, part of Europe. And again, we saw a beginning in 1999, at least with a consultative paper on the need to revise the rules. The Accord, as it was called then, had sort of become weakened to the extent that the rules were no longer risk sensitive. So that 99 consultative paper developed further, 2001, 2003. In June 2004, a new accord was born. Again, it was Basel II, and Basel II focused mainly on dealing with the risk sensitivity part, which is the risk-weighted assets. And beginning of 2007, Basel II was launched, and lo and behold, before we could even see the fruits of this new accord, in the second half of 2007, a crisis started to develop in the US and later on spread across the world. So, and as usual, when people started talking about Basel III, there was resistance from the regulators that Basel II is still okay, just needs some quick fixes. We went into Basel 2.5, but anyway, for sure, Basel III was born, and in December 2010, the Basel III document was published. Now, Basel III introduced something quite new, at least in the capital regulation since the 70s, which is a leverage ratio. And the leverage ratio was introduced so that it could act as a backstop on the risk based framework. So the risk-based framework has, which started sort of to develop, following some seminal work. I would say, like a paper by Kahane in 1707, Coyne and Santomero, Kim, and many others that wrote, in the so-called mean variance, analysis. Because at that time, capital requirements were not risk sensitive, so they were fixed, ratios. And the argument was that when banks, competitive banks, are constrained, then the only way, within the portfolio is to increase, risk so that they can increase the return. And since there's no penalty, for taking risk in that framework, I mean, they would do it. And in fact, Kahane, for example, did, argue that the only way, to ensure that this is not abused is to regulate the asset portfolio. And like I mentioned, so many papers later on developed on that, and then we had the risks weighted assets. Now, Basel III is unique because, the leverage ratio under Basel III is unique in the sense that it's now part of the, the part of the, together with the risk, based, framework, which was also strengthened. So, and, Basel III was to deal, with excessive leverage, so which was part of the main cause for the global financial, crisis. And therefore, a 3%, threshold of Tier 1 capital in 2014, there was still some discussion that whether this 3% would be common equity Tier 1, but by the time the rules were finalized in 2017, that was not, the case, and hence a lot of opposition has, followed. But so how do we rate, Basel III overall? I think if we look at how the banking sector, global banking sector, sort of, went through, the COVID-19, crisis. So we could say that, and a number of reports by the BIS have been done, to show that the liquidity and the capital standards in Basel, III did help the financial system to sail through the COVID-19 pandemic. But the real stress test for Basel III perhaps is the 2023, banking crisis in the United States and also in Europe, in Switzerland, with Credit, Suisse. So this has actually sort of again ignited, debate, analysts, policymakers again are back, trying to see whether we really need to, clean up, this Basel III framework before it is, too late. In the resolution of, say, Credit Suisse, for example, we see that, the use of, additional Tier 1, equity became, controversial, and it really disturbed the, part of the capital, markets for that, instruments. So in the US, of course, there's also a number of, position papers that are going through to try and, strengthen the banking system as a whole. As you may be aware, in the US, it's sort of a proportionality approach. Only a few banks on Basel III, whilst the rest are still on a combination of Basel I and Basel II. So would we say we are yet at a crossroads again in terms of banking regulation? Maybe yes, maybe not. Maybe we might say it's just a regional, banking crisis relevant, to the US and Europe. But then I look at, our region, sub-Saharan, Africa, and look at some of the challenges, that we currently have, and think that we may be sitting on a time bomb. Sub-Saharan Africa, faces a number of significant, risks and some vulnerabilities. So, which in combination could undermine the banking or the financial system of the region. Talk of the energy and food crisis, high inflation, debt distress, and also the need to recover from the effects of the COVID-19 pandemic. In addition, in sub-Saharan Africa, we have the most, or the highest and most volatile non-performing loans, ratios. And the other thing is that a number of, countries in sub-Saharan Africa, during COVID in 2020, 2021, took some, some measures to try and protect the financial system. So these regulatory measures included suspension of, provisioning rules, classification of, loans, and including, the implementation of Basel III rules for some, countries. And I've seen some of the countries, including Zambia, have already started, to reverse some of these regulatory, measures, which in the coming years, we're not sure what, risks that could lie in that, space. And the other argument that has always been there is that, look, Africa already has very high capital, ratios. So implementation of, Basel III in Africa really shouldn't, we shouldn't spend, so much, time because the capital ratios are already way above, Basel III. So whether Basel III it's an imperative for sub-Saharan Africa, others argue. But I also want to think that there are some factors that really explain why these capital ratios, are very high. One of them is, risk averseness. So, and a number of our, banks, I'll show you later just to look at the Zambian, banking sector. The banks are, risk averse. So you find loans as a percentage of the balance sheet less than 40%. So the lending conditions are not favorable. But we also have issues, in terms of, banks properly provisioning, so which could lead to these understatement of loan losses, and then overstatement, obviously, of the capital ratios. And then the third issue is it has to do with dollarization, and which, leads to erosion of banks, capital bases over, time. The foreign exchange rates are very, are volatile. So with a balance sheet that has, dollar assets or liabilities between 30 to 40, percent for some of the countries, makes it, difficult to keep, banks, floating. So in that, regard, tier one capital ratios may not actually be an indication of the availability of the actual equity that could be available. So normally risk-based, capital requirements in some circumstances are undermined. Like I mentioned, in dollarized, economy. So you'll find in an economy where there's risk averseness and then it's highly dollarized. So you'll find 60% of the balance sheet is liquid, in terms of government paper, in terms of, foreign, balances. So when you, in that case, although, banks would, it's very easy for banks, to meet the capital minimum, capital requirements in terms of the risk-based, framework. But risk-based capital requirements are also a problem, when the solvency of the country is in doubt. Remember the Greek Cypriot crisis, Bulgaria as well. So when, sovereign debt, became a problem, the sectors were completely, wiped out. They had to use, public resources to recapitalize them. So I think, given the way, in the context of sub-Saharan Africa, where we are with, most of our countries, riddled with, debt, we should, start to seriously, think of implementing a binding, leverage ratio, just to ensure that, the balance sheet has sufficient, equity to withstand, losses, which could, come from anywhere. The operational risk, is high. So, and sometimes in a dollarized economy, even a single, loan, when the exchange rate just, sort of depreciates significantly, could wipe out, that capital. So normally, a leverage ratio, is preferred. It's simple. It's quite, robustness, especially for those that are using, a model. But I think it also helps in avoiding, gaming the system. Each time, in sub-Saharan Africa, from my experience, you try to increase, these ratios. What some of the international banks do is simply to shift, part of the balance sheet. So they just decapitate the balance sheet and move some of the good assets into centers like, Mauritius. So no capital, flows in. So, and then comfortably, they will meet those, risk-based requirements with ease. But when, you have issues in the economy, then, the issue of capital, I think it's not debatable. So given that, background, we set ourselves, some objectives to try and see how we could contribute to this, debate. Our aim, therefore, is twofold. So number one, we want to assess, whether a leverage ratio requirement, that is far too high, meaning that which is, quite, binding. And so whether that would incentivize, banks to shift, their portfolio towards high risk assets, like in the mean, variance portfolio risk analysis, from, say, relatively low liquid assets. And given that, the objective of capital requirements is to reduce the probability of bank failure. So our ultimate objective is to try and investigate the effect of such a high leverage ratio would have on banks' insolvency risk. And to do that, and we aim to do that empirically. So in terms of the gap and, contribution of the study, having gone through a literature review, we find that two relevant streams of literature, which have been developing since the release of the Basel, III document in 2010, I've sort of taken some rounds. One is a debate that look at 3%, leverage ratio is literally, calling it a joke. So if, banks, if that leverage ratio, they argue, existed before, the global financial crisis, it could have done nothing. So to prevent, banks getting back into the toxic assets and building up on leverage, then there's need, to come up with a leverage ratio. And I think, Admat and Helwig, and I mean, later on, even published, a book with just, to argue this, matter more comprehensively. And I think they were among the first, to propose that actually 20 to 30%, leverage. And I mean, they're not talking about, African countries, but on a global basis, that 20 to 30% is what is required to ensure that, our banks remain, strong and robust, given these, crises that we've come to live with now from, time to time. There are others that have, similar, thresholds in terms of the capital requirements. In fact, a survey that I, found by Ambrosio in 2020, where about 150 experts on bank regulation, were interviewed. So about a third of them think that a 20 to 30% leverage ratio. Although in this study, we we don't have any threshold yet in mind, but we just want to see whether we can empirically, because most of these arguments are largely theoretical. So, and the gap exists, where, especially if you combine it with another, literature, a body of literature that is sort of like arguing that, look, since the Basel III is explicit in terms of the need to enhance the quality and the quantity of, capital, the objective is for banks to actually raise capital and not to do any balance sheet, gymnastics like, reducing risk-weighted assets and easily meet these, requirements. So a number of, papers, have been done to argue, because some empirical, evidence have shown that. I'll talk about it, I think, shortly, in some of the experiments that have been done, in Europe, to show that actually, banks given a choice, they will do what, best, suits them. So sort of this, board of literature is, recommending that to a more effective way is to actually direct these banks to increase their equity so that they can reduce leverage, not to reduce through shrinking of, assets. So our research is that, at the center or intersection of these two sets of, literature, and we're not aware of, papers that have sort of looked at this matter at in terms of getting at the intersection, and also proposing a framework that actually requires banks to inject equity and no other option is given. So we hope, thirdly, that our work will have some significant policy implications in terms of the design of the Basel III inspired, regulations in countries like Zambia and others in sub-Saharan Africa. Now, why Zambia quickly? I think Zambia is a good, case study. It's a typical sub-Saharan African, country dependent on copper as a main, export. Zambia also was in the news as the first, country to default on the euro bonds during COVID-19 pandemic, and also became the first, country to negotiate under the common framework. Okay. Then the other issue is Zambia, like Mozambique, Ghana, Tanzania, Sierra Leone, are countries that have been classified as highly, dollarized. So they have a similar, balance sheet, structure. So quickly, just to give you an idea of the structure of the balance sheet, so that you have an idea when I get into the actual design of the experiment. In Zambia, subsidiaries of foreign bank, I got this from the 2022 Bank of Zambia annual report. If you need a full list of banks, they are listed on the website as well. So subsidiaries of foreign, owned banks have always dominated in terms of the total assets, the total loans, deposits, as well as profitability. So this shows over a 3-year period, although there's sort of a decline as some of the local banks, especially those with government stakes, just a few of them are getting big and stronger. In terms of the assets, you could see that net loans and advances in 2020, just about 29%, 2021, just under 27%, in 2022, just under 26%. But you look at the balances with foreign, financial institutions, just under 23% in 2020, under 20% in 2021, the same in 2022. So when you combine this with, investments in government securities, 24% in 2020, 26%, 29%, you can see the, structure of this balance sheet, highly, liquid. So there's still room for lending. In terms of the financial indicators, quickly again, the capital adequacy ratios, the Tier 1 ratio at about 22% in 2022. A Tier 1 ratio in Zambia is actually all equity ratio, and the rest of the CAMEL indicators are shown in there just to give a perspective once I get into the discussion for today. In terms of the literature review, of course, corporate, finance literature is, rich in terms of, models that have helped, develop most of these, models on bank, capital regulation. Talk of the 1952 Markowitz portfolio theory, M&M capital structure relevance in 1958. So normally this is, always in a study on capital. That's a point of departure because of a number of frictions that exist in the real world. So because we're looking at aspect where regulators would have to compel banks to meet a requirement in only one way, by increasing equity. So therefore, these theories help us to sort of to conceptually understand. So that's how I bring in the pecking order theory as well. We believe that because raising capital, it's either internally through profitability or actual injection of capital. And we also combine, in terms of the theoretical framework, some of the relevant theories on risk-taking behavior under bank capital regulation. Like we look at moral hazard, franchise value, and regulatory theory as well. In terms of the extant literature on Basel III and perhaps capital regulation in general, we also look at a number, of papers. One thing you will notice from, some of the papers that I'd referred to, or some of the scholars, is that Basel III, in all fairness, has tried looking at where, we are coming from, has tried in terms of enhancing the minimum capital requirements. So both in terms of the risk-based framework but also the introduction of, a leverage ratio. But this reform agenda, I think, unlike the others in the past, has received so much, resistance and opposition from both academics, policymakers, because they argue that, look, we need to emphasize more in terms of equity, and we should be focusing on an equity to asset, leverage ratio, and at least well beyond, the 3% proposed. So 3%, in fact, under, Basel III, it's not even all, equity. So I did mention this Ambrosio survey that was, done, who sort of, proposed for a much higher leverage, ratio. And in general, literature on capital regulation has, been inconclusive. Some studies indicate that high capital requirements lead to increased risk taking. Other studies that it leads to lower bank risk and improvement in financial stability. However, the findings on the leverage ratio, I'll spend a bit of time, somehow show some consistency in terms of the overall impact on financial stability. So, for example, Bath and Miller 2018, they show that increasing the leverage ratio actually from, say, 4% to 15% leads to a reduction in the probability of bank failure, although they note that lending is affected. Kiyama, Jokview, based on the European data, demonstrate that imposition of a leverage ratio actually changes banks' behavior. It induces them to move from low-risk strategies into high-risk strategies. However, they note that once they reach a point where a leverage ratio is no longer until they reach a point where the leverage ratio is no longer binding. Choi and others, 2020, based on the US, the largest US banks, their results, show some risk shifting, that a leverage ratio actually encourages, banks to venture into some high risk assets. But in the US, mainly, they are looking at some of, the toxic assets. But however, they still show that there's strong evidence that despite the shift, the overall a leverage ratio leads to a reduction and improvement in the financial stability. Acosta, Smith and others, again, using EU data, they also examine specifically the trade-off, between additional loss absorption capacity associated with an introduction of a leverage ratio, and then the potential for these banks to shift in high risk, assets. There are evidence, both the theoretical and the empirical part, show that introduction of the leverage ratio leads to more stable, bank. Since the explicit, goal of Basel III, reforms, given where we coming from in terms of, how the banking sector had become, prior and during the global financial crisis. So there was need that there's need to raise the quantity and the quality of bank, capital. So others have strongly argued that, look, the only way is for regulators to focus on ensuring that banks infuse the actual amount of equity to meet objectives, for example, of implementing, Basel III. It's the only way. In fact, Kasonde and others, their contention is that while we all agree that intervention, especially in certain, times of, high capital requirements, sort of, to ensure that banks, are recapitalized. But you also need to look at the, specifics of such an intervention, because it matters. It's the regulatory policy, strategy matters actually in some of these, things. So, specifically, I just wanted to draw you, just, to show where these, arguments are stemming, from, like, for example, Gropp and, others, Juice, Rad. The European, Banking Authority capital exercise of October 2011 has attracted a number of quasi-experimental, which have been, done, of course, looking at various, aspects. Now, the EBA, following the stress testing exercise in July of 2011, identified 61 European banks that, based on the asset size, which needed to increase their core equity, core tier 1 capital from 5% to 9%, at least within, the next few months, let's say by June 2012. The objective was to restore public, confidence in these large, banks by strengthening their capital base. Especially the concern was arising from the sovereign, bond issue. I did mention some of the countries in 2012, 2013 in Europe that had, serious issues. Now, to meet the requirements, the EBA was specific that banks must use their retained earnings, suspension of, bonuses and other perks, for the executives, or the use of, strong capital contingency, instruments, and that they should not, resort to reduction of, observed to meet this new requirement. But what happened? So some of the, studies like Gropp observed that, look, actually, what happened. So the banks under the EBA, on average, just reduced the risk-weighted assets, and this, created an increase in risk, whether it's a systemic risk or bank-specific risk, as the other, studies that have used a similar EBA as a quasi-natural experiment. Now compare the EBA with the US, situation in 2019, just coming out of the global financial crisis. So between February and May of 2019, the Fed conducted actually a supervisory capital assessment, program, or SCAP. This was the first national supervisory stress, test, and they focused on the largest 19 banking, groups, BHS, and the objective of the SCAP was to assess whether these large, U.S. banks had sufficient, capital to continue to intermediate, especially where we were, coming, from the crisis with the U.S. in recession and so on. So so this was, important. Deleveraging by reduction of assets, especially loans, was not an option in this, case. And what happened? So at the end of, the SCAP, about 77, billion in terms of core equity, capital was raised. So, and the SCAP in 2011 is now it has now evolved into the annual comprehensive capital analysis review. So it's this event is the one that has sort of encouraged the, the literature on the need for regulators to actually compel banks to raise equity, because it is quite an effective way of ensuring that the banking sector is recapitalized. I think for the US, probably it's also a learning, curve. They focused on the big, banks, and they recapitalized. But what happened in the first quarter of 2023, we saw some of the, banks, sufficiently large banks, but that were not part of, this exercise, because they are considered as not systemically important. So they failed, and now they're trying to, fix that issue. So in terms of having reviewed, this literature, and just to show where we are coming from, we try and, start to develop a working, hypothesis. So a few questions that we think, needs to be looked at in developing a set of testable hypotheses. For example, what is the likely effect on bank asset, or portfolio risk, and the overall solvency, risk of banks if, let's say, regulators in sub-Saharan Africa or in Zambia, for example, opt to enforce a leverage ratio requirement that is quite, high, binding, along with the mandatory requirements for banks to raise new equity. Would such, a policy measure lead to an overall reduction in the banking, sector risk, like some of the studies have shown, or would it induce an increase in risk-taking behavior and eventually weakening the financial system, again, as some set of empirical studies have also shown. So the innovation of our paper or research is in the fusion, I did mention this before, of these two distinct strands of literature as a foundation of our two research objectives. Okay. So in developing our hypothesis, so for the first hypothesis, so which deals with the first objective, which is to assess whether there's risk shifting behavior in terms of the portfolio risk. So our hypothesis is that an exogenous shock, like the new capital adequacy framework, which I'll come to in Zambia, to a bank's, capital leads to a significant increase in bank risk, taking behavior because of, banks' risk shifting, tendency, and therefore suggesting that changes in capital and changes in risk would be positively. So in this case, when regulators compel banks to raise, equity, so there will be that, positive relationship. Our conjecture is that, where regulators have, decided to raise the bar, obviously, for regulators, the idea behind capital requirements is that when, risk increases, banks should commensurately also increase the amount of, capital. Okay, so that's that's the deal. Not that banks should not, take risk. So if regulators are the ones that, come and then raise the bar, then they expect that banks will, take on risk until to a point when, it is binding, for them. And to lend more, then they would have to increase their capital as well. So in case of, say, the situation in Zambia, in developing our hypothesis is that because capital requirements were substantially, increased, so the impact on the different size of, banks, the small banks and the big banks would be different. On the big banks, our conjecture was that because these have got at least good lending opportunities, so they should be able to convince some of the, their good clients to take on more, credit. And so for them, it would be in sort of like what the regulatory hypothesis would, predict, that if risk increases, capital should increase and so on. But for the small banks, because these requirements, were set regardless of size, we thought it's more of a moral hazard, issue. So because they would have now to start, building up their portfolio, and I think from experience in Zambia, we saw that, happening. So therefore, our hypothesis, one, so the first part, H1A, is that a far higher leverage ratio increases bank portfolio risk because of this risk shifting behavior. So in this case, the coefficient on our DID equation, so the beta equals the DID term in the risk measure. And for portfolio risk, we're looking at least using two measures, the average risk weight, or the risk-weighted assets to gross total assets, and also the non-performing loans ratio. And so the risk shifting hypothesis actually implies that the beta, the sign of the beta, coefficient would be greater than 0 or positive. Okay. Now, an alternative hypothesis is that because of the time, sometimes regulators, wants these banks to recapitalize. Like in case of Zambia, banks were given up to 1 year to raise the capital. So in that case, a number of banks, the best thing to preserve, the franchise value, they would at least put these resources into government paper or other foreign exchange activities, like balances in, with foreign institutions. So, and therefore implying that an increase in capital would lead to a reduction in risk, taking, and implying a negative relationship. So our alternative hypothesis 1B is that a far higher leverage ratio decreases bank portfolio risk. Okay. But then ultimately, we want to see, what's the impact on the bank solvency? Because after all, that's the objective of minimum capital requirements, to try and reduce the probability of, banks, failing. So, we sort of follow the theoretical model developed by Acosta Smith, Grill, and Lang in 2020. So in their model, it's a combination of a leverage ratio along with the risk-based capital requirements. So they show in their model that actually if equity is sufficiently costly, when you impose the leverage ratio, it will incentivize banks to shift into high risk assets, okay, which is agreeing with the mean variance portfolio risk analysis, okay, and which led actually to the introduction of the risk-based requirement. Because under the risk-based framework, if banks have to increase risk, then commensurately they should also increase the capital, but there's a marginal cost to that, so it constrains behavior. However, their models still suggest that a leverage ratio is beneficial, as overall it leads to a reduction in the probability of bank failure, and they're able to prove it theoretically, but also using empirical data on the EU banks. The issue is that the leverage ratio leads to an increase in loss absorption capacity of these banks, because they argue that to risk taking there's a limit. So banks, even if under the leverage ratio, banks can take on risk because there's no marginal cost to pay in there, but they can only do this up to a certain point. In fact, under the combination of risk-based and leverage ratio, when the leverage ratio is no longer binding, then they fall back into the risk-based framework, and that's somehow the approach that we've used in Zambia. I'll talk about it, although we're not focusing on the leverage ratio, but we focus on an absolute amount. And then the other argument is that, okay, there's also the issue of skin in the game. So how much risk would a bank take without also risking their own investment? So they will be constrained in terms of risk taking. So they argue that as long as the risk-based requirement applies alongside the leverage ratio, then banks would be constrained to take undue risk. Okay? And so in our, developing our second hypothesis, we continue to argue that because, the intention of regulators is to limit leverage, and for regulators, in fact, when they set minimum capital requirement, their expectation is that banks would meet this through good deleveraging, that is raising equity capital, as opposed to bad deleveraging, which is basically reduction in risk-weighted assets. So banks should either bring in fresh issues of equity capital, or cut down on dividends, executive compensation, and other things in order to build capital internally. So given this, we therefore hypothesize that the insolvency risk of banks can be effectively reduced by enforcing a more binding leverage ratio, as long as banks, are directed to meet this requirement by actually injecting equity, because this increases their loss absorbing capacity. So therefore, our H2 is that a far higher leverage ratio enforced by banks injecting equity capital reduces banks' insolvency risk. And in this case, the coefficient on our DID regression, the coefficient beta would equal the DID term, and using the risk measure, log of inverse of Z score. And the hypothesis implies that beta should be negative to show a reduction in the risk of insolvency. And we support this hypothesis by the regulatory hypothesis, but also the franchise value, because when regulators, compel banks to raise, in most cases, they will do so because of the regulatory costs that may come with non-compliance, or to preserve their franchise, value. So in extreme case where the regulator may, take over a bank that is a non-compliance, it means that shareholders will lose the franchise value in that operation. Okay. So to help us, achieve all these, things, or our objectives, which we've, set, is that we frame our study within the context of the implementation of a new capital adequacy framework in Zambia in January 2012. So what happened? The authorities increased, the requirements quite significantly from the current level, which was 12 million kwacha. Okay, at that time, before rebasing in 2013, that was 12 billion kwacha, an equivalent of 2.5 million, dollars, to the equivalent of US 100 million, so which was 520 million, kwacha for foreign-owned banks, and then 20 million for locally owned banks. So definitely, this led to an economically significant increase in the minimum capital requirements for foreign-owned banks compared to the local banks. They also stipulated that this the tier 1 capital should be all equity, 80% paid up capital, and then the remaining in terms of retained earnings. So we believe that the new capital adequacy framework in Zambia, serves as an ideal quasi-natural experiment to help establish the causal effect of, a far higher leverage ratio requirement, say, on banks' risk-taking behavior and also solvency, at least for two reasons. It's quite, difficult in capital, regulation to find a situation where you can have, comparison, groups. So normally when capital requirements are increased in a certain, jurisdictions, unless, for some reason, like, for the systemically important, banks like the EBA exercise, or in the US I mentioned, but ordinarily capital requirements would apply, to all banks. So if there are no comparison, then it becomes, difficult to have a treatment and a comparison, group. And then also capital requirements normally vary very little over, time. So, so identification of an exogenous variation in capital becomes, an issue. So for us, we believe that the NCF offers the most suitable, laboratory for a prospective adoption of a leverage ratio requirement far exceeding, Basel III standards, both in terms of quality and in terms of quantity of capital. When the new capital adequacy framework was issued in 2012, actually, it was equivalent to, for example, increasing a regulatory minimum bank equity asset to asset or leverage ratio, say from about 9.9% to 24% for foreign-owned banks. While for locally owned banks, the effect was much smaller, like from 11.4% to 16.5%. So to achieve our objectives, the NCF, the abbreviation of our experiment, helps in that regard. So, and the NCF offers arguably a most relevant, policy shock, because banks were required to recapitalize only in one way, raising of equity. They were not given options. For example, if it was a capital ratio, banks could have met it by reducing their risk-weighted, assets. Okay, so data, I'm just trying to be mindful of the time. So data and methodology, we use the supervisory, data which banks do submit to the Bank of Zambia. So it's a lot of balance sheet, income statement, and capital schedules. And then we prepare our data set in Stata, and our sample period spans from month 1 of 2006 after cleaning up to 2019 month 2. Our variables, we use the standard, variables that have been used in capital regulation of this, nature, like Tier 1, the capital asset ratio or leverage ratio, loan loss allowances, the NPL ratio, and then for solvency, we use the Z score, and then the other measures, which have provided a number of papers, including some of the papers that were done by the network members. So our estimation, it's basically because these requirements were sort of homogeneous. Everyone was required, within the set to meet. So we can use just a canonical DID, regression. So which is a two-way fixed, effect. So the dependent variable is any of our risk, measures. So YIT, so either the average risk weight, or the NPL ratio, or the Z score. And then we have our firm fixed effects to account for bank-specific constant differences and business models. And then our month fixed effects to control for time-varying aggregate factors that affects everyone in the space. And then we also have a rich set of controls, which we lag by one period. Mostly the camel indicators and other bank fundamentals. And the NCF bank is our dummy variable indicating whether a bank is foreign owned and therefore is required to meet the higher capital requirements, otherwise 0. Post is a dummy equal to 1, indicating a period following the implementation. And then the DID term is the interaction of the NCF bank and post. So the use of the NCF raises some endogeneity concerns. So, because the key assumption we make is that the implementation of the NCF was exogenous to the bank's capital management decisions. So the most important, challenge to empirical identification of the effect of higher capital requirements on banks' risk-taking behavior is to find this exogenous, shock. So therefore, we want to try and address these endogeneity concerns. Our objective in this study is to provide evidence supporting a causal interpretation of the observed effect of the NCF on the bank risk-taking behavior, so that we can make proper policy recommendations. And two concerns to do with endogeneity. One is the simultaneity. Because it's always a problem, to do a study on capital and risk because of the simultaneity. It's like the issue of the chicken and the egg, which comes, first. In setting their risk appetite, banks' capital is an important, factor, and also the, opposite, when risk increases, capital becomes. So there's that issue. So most studies are plagued by endogeneity, issues. We tried to think through, why did the authorities isolate just one sector? Could it be that they were concerned with the financial condition or the risk in these foreign banks? But based on our review of the annual report, we couldn't find any, suggestion. And then we also look at the economic climatic conditions at the time. They were quite, fair weather. The economy was, literally doing fine. So, so it's really, we didn't think that an issue of reverse causality would be, a serious problem. I'm just hoping I would be able to be, assisted with the comments on this matter, so that we could do more work on this one. Then the second issue is to do with omitted variable, bias, because the focusing on a specific institution then brings in that unobserved, heterogeneity related to this specific institution. And we saw that foreign, banks, actually some theories that some set of theories indicate that foreign-owned banks would be riskier, operating in a local environment because of lack of knowledge, so information asymmetry in the local market. But another opposing hypothesis is that foreign banks, because they come as part of a strong network, risk management capabilities, good training and so on, they will tend to be less riskier. But we also looked at some of the empirical studies that were done in the West African, Monetary Union, Kanga and others, 2020, 2021, Saidan, 2021. So who showed that actually foreign banks, specifically the French banks, compared to the domestic banks, were less, risky. So, so encouraged by that, I'll come back to the issue when I introduce the instrument shortly. For expedience of time, let me just, this table one is just the descriptive stats. And then the other issue, for DID is the parallel trends, assumption. And now it's practiced in most papers to do a graphical representation, but also it's a statistical test is available. Although, I mean, the DID is based on a counterfactual. So, yeah, so it's a combination of, some graphical representation, and you could do a test and then and sort of try and infer whether a parallel trend did exist before a policy intervention. So, and we looked at, the average Tier 1 risk-based capital ratio. So you could see that prior to 2012, month one, the trends really between the local and the foreign banks were not, very much, distinguishable. But after the introduction of the, high capital requirements for the foreign banks, you could see an improvement in the solvency of the foreign, banks. It just shot up, and it remained for quite, some time. We also did the same using a Z-score, the inverse of the Z-score. Again, you could see just after 2012, a significant reduction in risk for the foreign banks. Then we combined that with, a statistical test, which also suggests at 95% confidence that there is no statistically significant difference between the trends in the NCF and the non-NCF banks, at least on a monthly basis. So let me now go through the main empirical results. Firstly, in our objective one, we try and see whether there is risk shifting. Did the risk-weighted assets, post the implementation of the new capital adequacy, framework increase, so that we can test our hypothesis H1A and H1B. And for that, we use the ratio of the risk-weighted assets to total assets, and also the NPL ratio. And then the main results is where we want to see what happened if there's risk shifting. What's the implication on the overall solvency of the banks? I hope you can clearly see the empirical results. So if you look in the column one, where we have risk-weighted assets to total assets, and the interaction term, because we were testing for whether beta, the risk shifting hypothesis was that beta would be greater than 0. So it's positive and significant. So we use all the controls, including the bank and fixed time effects. But when we use the NPL ratio to look at portfolio risk, the results are statistically not different from 0. So it looks like whilst the risk-weighted assets on average increased, but the portfolio risk remained almost the same compared to the period before implementation. Okay, and so we also wanted to see what happened in terms of the portfolio shifting from low-risk assets, which are government securities, foreign balances, and also in terms of the high-risk assets represented by loans. In columns 2 to 3, the results are not statistically significant on the DID term. I'm still trying to figure it out, but I think what happened is that as banks within, the portfolio, moving some of the cash which could have been put in government paper or foreign balances should have ended up in lending, but they probably, as the NPL ratio show, that lending, I think on average, remains some good, lending. On the overall now, to see the impact, which is the objective of the minimum capital requirements reduction on, solvency, whether solvency risks reduced. We ran 4, different models to try and see the influence of the different, controls. So in column 1, other than the bank fixed and time fixed effects, we do not include any controls. The reduction the sign on the DID is negative, and it is statistically, significant at 1%. And in the brackets, these are T statistics, robust T statistics. So it shows that, and you can see across all the 4 scenarios, the results remain statistically significant, and the signs remain, negative. When we exclude the proxies for camels in the second column to see whether fundamentals such as, bank size would have a significant impact, the results do not show, that. But when we exclude these fundamentals and include just the camels, the reduction in the coefficient is significant. So although the sign is retained, so this clearly shows that the bank's current financial condition and performance is very relevant. And our main results are in column 4, where we include all the controls and the fixed effects. And again, we see the sign being retained, and although there is a slight reduction in the size of the coefficient. And then then we also run an instrumental, variable, approach. So because of the certain unique nature of the foreign-owned banks, and which could bias our results, so we needed to find an instrument that would help us to satisfy ourselves that that's not a very serious worry. So for example, Berger and others, 2005, show that foreign banks, because they are part of large networks, and they have other advantages, including the multinationals that will move with them wherever they go. So they've got provide good lending opportunities, better risk management capabilities, and tools to properly manage risk. So they have certain advantages. And when we combine that with the empirical studies by Kanga and others, 2020, 2021, Saidan, who have shown that foreign-owned banks, specifically those of French origin, exhibit a lower degree of overall risk, including comparison with Pan-African banks in the YM. So they were able to show that. So we got inspired and developed an instrument so to show that we could instrument for the superior risk management capabilities and technologies based on affiliation with these holding companies. And to help us, we picked our instrument as if a bank is a subsidiary of a bank that is whose head office is a member, is in a jurisdiction that is a member of the Basel Committee on Banking Supervision. So the BCBS, parent bank affiliation in short. So it takes the variable 1 when a foreign-owned bank is a subsidiary, otherwise 0. And then we run the instrumental variable regression, explaining the effect of far higher capital requirements on risk-taking behavior. So in our IV regression, we regress the bank affiliation variable, and then we use all our controls, the camels and the other bank fundamentals. And we also, argue that the instrument satisfies both the relevance and the exclusion restrictions and our IV results are shown in column 1 and 2. I'll come back to that. But also a concern on the selection, bias. We also run the Heckman's selection, model. So both results are shown in the in table 3. So you can see that in column 1, the parent bank affiliation is statistically significant at 0.637 and at 1% and then the final two stage regression results in column 2 still show some consistent results, so similar to our baseline. The size of the coefficient in the baseline was 0.48. We have 0.43, which may indicate that the advantages of affiliation in this particular case was not really a big issue. And also the other statistical measures like the validity of the instrument were also done. For the Heckman, the lambda is very insignificant, so which may imply that the issue of selection bias probably it's not a huge. But when we interacted to try and run the the main regression, although the sign is negative, but the results are not statistically significant. I'm still trying to figure it out why this is so. Yeah. So to conclude, the analysis of risk, taking outcomes in responding to capital regulation is particularly important because it helps us to evaluate, a prospective policy, like in this case, the adoption of a more binding leverage, ratio, and where banks are mandatorily required to comply by raising equity. The evidence provided by the quasi-natural experiment on Zambia indicate that actually there was a significant reduction in default risk, both statistically and economically. And so these findings are also consistent with some of the studies, for example, the theoretical study by Admat and Helwig, which suggests that actually when capital requirements are binding, they will lead to an overall reduction in risk. And the results also help us to illustrate the importance of a good strategy in terms of enforcing of a binding leverage ratio. So it would be, I think, appropriate to consider that in design of regulation in future. But we also see that probably to distinguish the banking sector in terms of varied capital requirements may not be a good idea. I think some papers that have referred to in Europe through the EBA or in the US, the failure of the 3 banks in March of 2023, which were not considered as systemically important and therefore were under less stringent capital requirements, would show. So probably within a banking sector, there's need to ensure that strong capital requirements apply. In case of Zambia specifically, these should apply to both foreign and the local banks, because effectively what the policy did was to improve the solvency of the foreign-owned banks significantly, almost 50% when you compare with the local institutions. And we think there's also hope that such a leverage ratio would, in terms of future or further research, that we may need to look at the interaction of a binding leverage ratio with liquidity creation. So I'll stop here, Professor. I know I've used a lot of time.
Yeah, let's give an applause to Raphael. I was being tempted to stop you after one of presentation or to push you to expedite the presentation, but it was so interesting all the way. This is a presentation that has all the granular details of the literature, the hypothesis you develop, the nature of the new capital adequacy framework for Zambia, and the testing. So I let you get away with the time element, but it was so interesting that I couldn't stop you at any point in time. There is so much work done here. But we possibly, I have some comments on the methodology, and also in terms of the interpretation on how this work could be taken forward. I can see a potential extensions of this work. And I know that the work is building on some of the work that I did jointly with ISOF, who is on the audience, and Desiree Kanga. But there's a good extension you did build on this, even in terms of variable definition. But let's take some comments quickly in the interest of time. Comments, questions, feedback, please. Okay, Bo, my eyes got Bo. I think there is a hand by Bo. Isof first. So Isof came first. Isof first and then Bo. So please go ahead, Isof. You work very prolifically in this particular area.
Yeah, okay, thank you very much, Raphael, and for very nice topic, and very interesting and very timely, actually. I mean, this is useful. Can you hear me first?
Yes,
yes, we can hear you.
Okay, right, yeah. I mean, Raphael, will excuse me, probably some of the things I will say, I mean, you have already mentioned them and so on, because I was on my car driving when you were presenting, then I didn't get a chance to pick up all the small details. But I just have a few comments on this. I mean, basically, probably on your period, right? I mean, the period post and pre, I mean, before and after, probably, I mean, it's good, I mean, to look at the implementation, but maybe also look at the announcement date, because usually when the announcement is made, maybe bank will start actually adjusting some of the behavior and so on, so on. Then probably it will be good to look at, I mean, that little bit, I mean, and also probably you should also check some of the papers that have already, I mean, also actually look at the leverage ratio even way after the financial crisis, because basically few countries actually had those leverage ratio already implemented even before the Basel III, actually. Canada is one of them, actually. And I will send you probably one of our papers where we actually look at that. And then we have been able to show that why the Canadian banking sector was resilient. This was part because of that ratio, actually, that was already in Canada, actually. But there are few countries that had that ratio, actually.
Thanks a lot.
Yeah, okay, right. And also, basically, the NCF, I didn't follow quite well when you explained the NCF regulation and so on, but the NCF, is it only about leverage ratio, or there are other regulatory rules inside of it? Then if there are other regulatory rules inside, basically, how can you actually separate the specific effect of the leverage ratio and the other effect, actually? Because basically, the Basel III there are capital ratios, but not only capital, right? I mean, because there are other things in the Basel regulation. Then all this can play somehow. Then it's not only, I mean, the leverage ratio which only will play, but there can be other effects actually. If you can disentangle this effect, that will be actually interesting. And also, we all agree. But I saw that when you were running the analysis, that was fine. I mean, actually, you really explained that. I mean, much better. But when you were arguing, I mean, your whole argument was made around the leverage ratio. But actually, in the banking sector, you cannot really make the argument only around the leverage ratio, because the leverage ratio and the risk-based capital are used, both of them are used, because each one of them has different roles, actually. The leverage ratio is to contain the leverage, but the risk-based capital is to contain the risk taken, right? Then you see, I mean, the risk, I mean, then you have to use both of them. Then the argument to say that if increasing the leverage ratio actually lead banks actually to take more risk, it will depend also if the risk-based capital is binding or not. Because if your risk-based capital is not binding, that means that you have more rooms actually to take much more risk. But as you see, that is depending really on how this or each one of this ratio, I mean, is binding as well. Unless, I mean, your risk part of it, the assessment of a risk-weighted asset is not well done, and then bank can actually do some kind of how do you call it? I mean, arbitrage, right? In terms of regulatory arbitrage, actually. Then you have to be careful on that actually in your analysis. Okay. But I think, I mean, beside that, I mean, I will stop here. But I mean, really very interesting, I mean, analysis actually. And I think, I mean, this is very promising actually. And thank you very much for sharing all this idea on the review, literature review, what people have done. And so it's a good, I mean, it's a good refreshing actually for us. Thank you very much.
Thanks, Professor.
Thank you, Yusuf. Very relevant and helpful comments as usual. And I like also the way you are pointing out to some of the modification that could be done in the paper. Bo.
Yes. In your presentation and discussion about paper, there was that the thing behind Basel I and II and III is that you should have reserves in relation to the risk you're taking. That different banks might have different strategies, business models, basically. And simply increasing the reserve requirement to make banks more stable, but that changes the rule of the competition here and might not be so smart, because the alternative is, of course, to improve on the basic idea in the Basel II and III to get a better connection between risk taking and reserves. So if you want to take more risk by lending out to more risky borrowers, then you need more high reserves, basically. And that's an interesting thing to explore that when I try to find out how they behave when we change the regulations here. So maybe there are effects on, you know, the competition and stuff like that. And again, if you want to attract more customers to your bank, well, then typically often you have to go then for the more risky borrowers. From the society as a whole, then increasing these reserves might not be so good, because you might hurt economic growth and say new, probably quite risky firms that need to borrow. So there is another dimension there that we have to think about also. Yeah, sure. But in general, I think it's very interesting to see the actual behavior of banks, but there's so much theorizing on these subjects. So yeah, thank you.
Thanks, Professor Bo.
Thank you, Bo. Very, very, very good comments. One of the things that if I combine Yusuf's comments and Bo's comments and Raphael's presentation, is that if this work was based on micro level data, that is bank level data by bank, which is I think it's now available in some of the databases. And in terms of and then because of the bank level, and then disaggregated, because we see that among the banks you have small, large. But I'm much more also interested in the behavior of these banks, if you take a simple identity of the basic banking model, a diamond type of work, I see you have a deposits, A plus equity on one side, sources of funds, and then uses of funds, you have loans plus securities. So you have the lending, the loan, this is captured here. You have the securities, purchase of, a government paper, treasury bills and all that. It was interesting to see on the table that actually the securities are 29% on securities compared to 25% on loans. Now, intermediation would require that maybe banks are directing more money to loans, maybe higher, the reverse of what is given here.
Yeah.
And I don't know whether this kind of dichotomy, they shifted towards a purchase of securities rather than loans, may be hiding some of the interpretation of this because under the new capital adequacy framework, NCF, when banks raise their capital, foreign banks, do they actually lend? Do they actually involve in a risky lending, which is the risky part of their portfolio would be lending? The purchase of government paper is non-risky. So do they actually participate in the lending, or they actually use 29% more? These are some of the granularity, but I see on the audience a lot of colleagues from the Bank of Zambia who understand the banking sector more than me, of Zambia more than me, understanding how the behavior of foreign banks as well as domestic banks may have panned out differently after the introduction of the new capital adequacy framework. So let's see whether we have more questions. Boy, is this a legacy hand, or you want to come in again?
No, it's just a second hand, so I'm finished.
Okay. So thank you. So Martin. Martin is also an authority in these areas. So I take Martin and then Oladapo, who is also researching in a similar area. So Martin first.
Yeah, thank you, Victor. Can you hear?
Yes, I can hear you very well.
Okay, thank you. And thank you, Raphael, for that really interesting presentation. I thought that, it's very good to raise in effect a third policy instrument for increasing capital buffers alongside the risk-weighted capital adequacy ratio and the leverage ratio. You're also introducing just an absolute increase in capital. And when Victor referred to the shares in the balance sheet of the banks and the very low levels of lending by the banks, it really would be, I think, in the interests of both financial stability and banking sector development, if there will be more capital, more absolute levels of capital, higher absolute levels of capital, and more lending of by the banks. And this third instrument, this raising the absolute level of the equity, seems to be one way of maybe achieving that, which the other two, the leverage ratio and the risk-based capital ratios, do not necessarily. I would like to ask Raphael if he could just clarify the results on table 1. Because from what I understood there, the risk-weighted asset, the capital to risk-weighted asset ratio increased. So there was a reduction in capital to risk, there was an increase in capital to risk-weighted assets, but there were no significant changes in the shares of the loans and the equity and the securities and the like. So is the reduction in is the increase in capital to risk-weighted assets ratio simply coming about because the banks are holding more equity? It's not because of any balance sheet changes.
Could you share table 1? Could you go to table 1, please, Raphael?
I think that should be table 2, because table 1, I think it's
the table that Martin is referring to.
I suspect is not this one.
No,
No,
that's
the other
good
one,
for
the
me.
one before.
Yeah. Trying to find it. This one, yeah. Yeah, I think this is the table, yeah. Because
Is that the one, Martin?
Yeah, yeah.
Yeah.
Okay.
So the risk-weighted assets, capital to risk-weighted assets is the first column, isn't it?
Yes, yeah, it is, yeah.
And that's
So
positive. So they're holding more
positive.
capital to risk-weighted assets. Now, these other things are the composition of the balance sheet.
Exactly.
And so your findings is that they didn't change.
Yeah. Yeah, they didn't change, much. I'm still trying, to figure out, but because I don't have a detailed, breakdown in my data set of the composition of the risk-weighted assets in terms of the components, it could have given me, insight. But I suspect it could, be the fact that because like treasury bills, for example, are zero risk-weighted assets. So maybe banks did increase a portion that goes into government bonds, which is risk-weighted at 20%. So you could specifically have some shift within the risk-weighted assets. But then I was expecting that the loans probably could have, contributed to that significant increase. But on their own, the coefficient is not statistically significant. So it looks like it's a combination of a number of things within the risk-weighted, assets.
Okay, and is there any evidence that they increased the overall size of the balance sheet?
Yes, yeah, because the NCF was actually an absolute increase in bank capital. So yeah, so and I mean, those who don't know, Dr. Brownbridge has done a lot of work on Zambia. He's an authority. He's I met him in London actually when I came for the CGF conference. Yeah, so we met over a cup of tea. A good guy. He's done a lot of work, some of which I reference here.
Thank you very much.
Yeah. Martin knows his stuff inside out. Thanks very much, Martin, for those observations. I'm sure you'll continue to interact between Raphael and Martin as your work progresses. So let me bring in Oladapo and then Oswald quickly. We are running out of time, so please go straight to the point. Oladapo.
All right, yeah. Well done, Raphael. Congrats on the paper. I just wanted to find out if your risk-taking covered off-balance sheet risk-taking by the banks in any way.
Yes, it does.
Okay, all right. So how did you capture that? Just
yeah, so so when I was trying, because the total risk-weighted assets I'm using, it's both on balance sheet and then off balance sheet. So initially, when I really wanted to understand what was actually happening, I also tried to isolate the off balance sheet. So I thought maybe the off balance sheet could explain. But again, it's not significant. So I left it,
Okay, thank you.
Thank you, Oladapo. Oswald.
Thanks to the presenter, Mr. Kasonde, for a very interesting presentation. I think this is some of the works that we're also looking at in the bank, trying to look at the treatment effects on banks from some of these regulatory reforms that we're implementing in Zambia. I'm also just starting to work in a similar area that Raphael is working on. So thanks for this detailed literature review, and especially how you are developing your hypothesis and then leading into your model specification and your results. I have two comments or questions. The first one is related to maybe how you can improve on the front matters, especially under the situation analysis, to make it more to give some punch, and that relates to the dynamics in the leverage ratio and the bank portfolio risks. So because that's the center of your paper, so if you can have if we can discuss and motivate these two variables in terms of their dynamics over time, it would greatly improve on the understanding of the paper.
Sure.
Then secondly, it's of course I totally agree with the various comments that have been put forward on the segmentation of commercial banks, because if you segment it or segment them by foreign and local, then there are all these dynamics, and that's why you need to probably look at other intervening variables that could actually lead to the results that you are getting. And therefore, probably, if you can also try to test based on the size of the bank. You can say small size. You can define what a small bank is and a large bank is, in line with most of the literature that look at the treatment effects of these reforms. They are looking at how small banks will respond vis-a-vis how large banks will respond, because then the characteristics will be the same in terms of the complexity of the businesses. They are likely to be similar. So probably you can do that, because if you look at foreign and domestic, you have a mixture of small and large within those categories. And therefore, if you are trying to see the effect when you have small and large embedded in the same factor, then it becomes a little bit more complex to try and justify your results. So I thought I should just comment on those. Otherwise, it's a very good paper. Thanks.
Thank you so much.
Thank you very much for those important observations and suggestions. Martin, your hand is still up. Is that a legacy hand, or you want to come in again? Okay. Yeah. Come in if you wish to. I can see your hand up, Martin.
Hang on, sorry.
Okay, it's a legacy hand. Okay, so let me take this opportunity to thank you all for this great seminar, and also in particular to thank
Professor, maybe just a quick one.
Just a moment. I want to call upon you. Okay. To thank Raphael for the great paper, and also to give him the final minute to say something.
Thank you so much. So in terms of size, Professor, what I did, I tried, because of the very fact that Dr. Oswald mentioned, to classify them into two groups, like small banks and big banks, because the asset size, especially at the time of implementing the requirements, was too wide. So when I interact the DID term with size, the statistical, test shows me that the effect is homogeneous. But then I think because the cross section is too small, we're talking of 17 banks. Yeah, so maybe it's giving me that. So I really wanted to do that cross section, but I abandoned it. It's the size of the cross section. Yeah. For the rest of the comments, I think they are all useful. I've noted down as I write. I'll think through and probably provide, a lot of clarity in my, discussion. So thank you so much, Professor, once more for this opportunity.
Well, thank you, Raphael. It is you that will give the final hand of applause for this great seminar based on real experiment in the real world, the new capital adequacy framework in Zambia with great applications because capital increases are very now common globally, but also around the rest of the African continent. Thank you very much. Thank you all for coming. I look forward to seeing you again next week. Thank you. Thank you indeed.
Thank you so much. Thank you.